Hi everyone, welcome back to Intermediate Financial Accounting 1. In this class, we are going to talk about income statement and related information. So specifically, we are going to first talk about the structure of income statement. Then we are going to talk about the continuing operations section of the income statement. After that, we are going to talk about the section regarding income from discontinued operation. And after that, the last section of our income statement is the EPS disclosure. So let's first look at what does income statement report. Income statement reports a company's performance during a particular reporting period. So in this definition, there are two key items here. The first key of this definition is income statement, it reports a company's performance. And then the second key word is it is the performance during a particular reporting period. So in other words, different from the balance sheet, which reports a firm's position at a specific point in time, income statement, it is a flow statement. So it reports the firm's performance during a period of time. What does income statement look like? So here I have some examples for you. Those are 5 examples from 5 firms: Starbucks, Pfizer, Apple, Intel, and Walmart. If you go on Island, you are going to see there's a handout there. So please look at the blank income statement, that handout. So it looks like this. And please spend 5 minutes, look at those. Those are income statements directly taken from the firm's 10K report from those 5 firms. I want you to spend 5 minutes, look at those income statements and tell me what are the similarities among those income statements and what are the differences. You can pause your video for now. So what are the similarities among those 5 income statements? There are 4 similarities. The first similarity is they all have the basic elements. So what do we mean by that? For example, all of those statements, they're going to report the firm's revenue. So they all report revenues, expenses, so different kinds of expenses, gains and losses. Those are income statement elements. All of them report those. The second similarity is they all report certain subtotals. So all report certain subtotals. What do we mean by those subtotals? So you're all going to see net income reported on those income statements. Income tax expense, that's another example of those subtotals. Income before income tax. So even though some of them are named a little bit differently, which we're going to talk about in a minute, but they are all going to report those numbers: net income, income tax expense, income before income tax. The third similarity is they all report EPS. So at the bottom of those income statement, you're going to see that all of them are going to have EPS disclosure. And those EPS, they're going to have the basic EPS and diluted EPS. So all report EPS. Both, and they all report both the basic EPS and the diluted EPS. Both basic and diluted. And the fourth similarity is they all report income numbers from the most recent 3 years. So that is also required. They must report 3 years number. Then what are the differences among those income statements? So the first difference is those 5 statements, it's pretty obvious that they all have very different layouts. The layouts are very different. And then the second difference is each item. So the specific items included in those income statements are very different. Let me give you an example. For example, for Starbucks is reporting something called company operated store revenue. And you're not going to see it on Pfizer's income statement. Because why? Because the business models of those two firms are different. For Starbucks, one of its major revenue source is company operated store revenue. Another revenue source is licensed store revenue. But for Pfizer, because of the difference in business model, so Pfizer is not going to have company operated store revenue or licensed store revenue. So, and then also for Apple, it's not reporting that. That is what we mean. The specific items included in the income statement can be very different depending on the business model of the firm. So the specific items included in the income statement are very different. And then the third difference is some of the items, if you look in detail at those income statements, you may notice that some of the items, they represent the same thing, but they may be named differently. Let me first write it here, and then we are going to go look at the income statement, and I will point it out for you. So even though some items represent the same thing, they are named differently. So here, so for example, first of all, let's just look at the title of the income statement. Those are all income statements. But if you look at the title, Starbucks is calling it consolidated statement of earnings. Pfizer is calling it consolidated statement of income. Apple is calling it consolidated statement of operations. Intel is calling it consolidated statement of income. Walmart is calling it consolidated statement of income. But those are all income statements. They are the same thing. Companies are calling it differently, which is totally okay. What you should realize is, like, no matter we call it income statement, statement of income, statement of our operation, those are the same thing. You look at a firm's 10K report. As long as you see such a statement which will report revenue, expense, it reports net income, EPS. If you see those, you need to know that it is an income statement, no matter what the company is calling it. So, and also let me give you another example here. For example, for income tax, Starbucks is calling it, where is it? Okay, so Starbucks is calling it income tax expense or benefit. Pfizer is calling it provision for tax on income. Apple is calling it provision for income tax. Intel is calling it provision for taxes. And Walmart is calling it provision for income tax. So you can see that even for income tax expense, different companies are giving it different names. In class, just to make it simple, we just call it income tax expense. But you should know that if you go look at a real firm's 10K report, different firms may call it a little bit differently, but they all mean the same thing. They're all the income tax expense. It is totally okay for firms to call it a little bit differently. So those are the differences and similarities. And then another thing I want you to look at from those income statements are, I want you to take a 5 minutes look at those income statements. And please tell me which numbers are coming from outside the statement and which numbers are generated inside the statement. What do we mean by that? So first of all, let me just take Starbucks as an example. For example, total net revenue, this number, where does this number coming from? It is coming from adding up these three numbers. So for the total net income, this number is generated within the statement. It is calculated from the previous three numbers. So I want you to look at the 5 income statement and tell me, please pick out the numbers which are generated within the statement, just like the total net revenue. Please take 5 minutes to do that. You can pause your video for now. So which numbers are subtotals generated within the statement? If I use this to represent those numbers generated within the statement, as you can see that for Starbucks, total net revenue is generated within the income statement. It is adding up the previous three numbers. And then total operating expense. This number is generated within the statement as well. It is the adding up of those numbers. So cost of sales, store operating expense, other operating expense, depreciation and amortization expense, general and administrative expense, litigation charge. Those, if you sum those up, those are called total operating expense. And then operating income or loss, this number is, if you take the total net revenue and then minus the total operating expense, plus the income from equity investees, that will give you operating income. And then the next one is this number. So earnings before income tax, that is if you take operating income and you add up those numbers, which are non-operating, so it seems to add up to be a positive number. So that's non-operating income. And then the next one is net earnings, including non-controlling interest. So this number is basically you take income tax, you take earnings before income tax, and then you take out income tax expense. That will give you net earnings, including non-controlling interest. And then the last number is this number, net earnings attributable to Starbucks. So this number is coming from, you take net earnings including non-controlling interest, and then you take out net earnings attribute to non-controlling interest. That will give you net earnings attribute to Starbucks. So those are the numbers for Starbucks. Those are the numbers, several numbers which are generated within the income statement. And then you can do the same thing for the other firms. I'm not going to talk about it here, but if you go look at the handout posted on Island, I have already crossed out those numbers for you on that handout. So you can try to do the same thing for the other firms and compare it to my handout. So, and then the next thing I want you to do is, I want you to take 5 minutes again. So please compare the income statement from those 5 firms. And can you identify some common structures of those income statements? So please take 5 minutes to do that, and you can pause your video for now. So the common structure of those income statements, our income statement, no matter whether it can be divided into single step or multiple step, which I'm going to talk about in a minute. But no matter whether it is in a single step or multiple step, it is going to have this structure. So it is first going to have income from continuing operations before income tax. And then we're going to take out income tax expense. That will give you income from continuing operations. And then if the firm has any discontinued operation, they need to report income or loss from discontinued operation net of tax separately. So this is net of tax. So this income tax expense is only for continuing operations. And then if you add up those two numbers, that will give you net income. And after net income, the firm also needs to disclose its EPS. So EPS disclosure. That is the basic structure of an income statement. And for the income from continuing operations before income tax, depending on the firm can have two reporting formats here. The firm can either report this portion, income from continuing operation before income tax, using single step or using multiple step. And the basic difference between single step and multiple step, for single step, the firm is adding up all of the revenues, income, gains, all of the things that is the income for the firm together, and then minus all of the cost, expense, losses, everything which are which will take away from the firm's net income. The firm is going to group those two separately, and then take the total revenue as an income gains and minus total cost, expense, losses, and then that will give you income from continuing operation before income tax. However, for single step, the firm is going to report it in steps, and then some of the firm so the most detailed reporting of multiple step is firms are first going to report revenue and then take out cost of goods sold. That is the gross profit. And then gross profit, take out operating expense, and then plus other operating income item. That will give you the operating income. And from operating income, plus income from non-operating activities, minus expense from non-operating activities, that will give you income from continuing operation before income tax. And then some of the firm may report gross profit, some of the firm may not. But the one of the major characteristic is for multiple step. Under multiple step, the firms are going to separate operating income, so the operating part and non-operating part, which we are going to talk about it very shortly in today's class. But the major difference is for single step, you are not going to say firms separating operating and non-operating. But for multiple steps, firms are going to separate operating and non-operating. So here again, the structure of a firm's income statement. So this specific example, it is an example of multiple step. Why? Because you are seeing gross profit here, total operating expense. So all of those, you are not going to say it in a single step income statement. But no matter whether it is single step or multiple step, as I just said, you are going to say income from continuing operations, like this portion, and income from discontinued operations. Some of the firms may not have this part. If the firm doesn't have any discontinued operation, the firm doesn't need to report it. So that's why that for some firms, you are going to say this part, some firms not. But if the firm has discontinued operation, they must separately report it from income from continuing operation. And then here is net income. And after that, that's the EPS disclosure. So the basic elements of an income statement, as we kind of mentioned previously, so the basic elements, the 4 basic elements of an income statement are revenue, expense, gains, and losses. What is revenue? Revenue is inflow of resource resulting from providing goods or service to customer. Expense are outflow of resource incurred while generating revenue. Gains are increase in equity from incidental transactions of an entity, and losses are decrease in equity from incidental transactions of an entity.